Every generation has its mania. The 1990s had dot-coms, the 2010s had crypto, and the 2020s, they have AI. The trillion-dollar dream reshaping global markets overnight. Since the launch of ChatGPT, artificial intelligence has become the gravitational center of finance and innovation. Trillions in market value, billions in venture money, and millions of jobs hang in the balance. AI stocks have powered over 75% of the S&P 500's returns, pushing markets into uncharted territory. Nvidia's valuation surged by $1 trillion in just 3 months, making it the first company to cross the $5 trillion mark. One firm built on silicon, code, and relentless ambition is now worth more than 2 Canadas, greater than the combined economies of all 54 African nations, and more than the entire crypto market, and even the world's total gold reserves. According to Silicon Valley Bank, 58% of all venture capital investment this year has gone to AI companies. But behind the gold rush lies a question investors can't ignore. Is this the birth of a new technological era, or the making of the biggest speculative bubble since 1999? It all began with one viral product, ChatGPT. Within days, it became the fastest growing consumer application in history, hitting 1 million users in just 5 days. 2 months later, it crossed 100 million users, a milestone that once took social networks years to reach. And by late 2025, it had transformed from a novelty into a global utility. Over 800 million people now use ChatGPT every week. It redefined public perception of what machines could do. Suddenly, AI wasn't science fiction. It was a productivity tool, an assistant, a disruptor. The reaction was instant. Microsoft poured billions into OpenAI, Google launched Gemini, Anthropic, backed by Amazon, and became Silicon Valley's next darling. Nvidia turned into the most valuable company on earth, minting record profits and selling the digital shovels, GPUs, that fueled the AI boom. Startups rebranded overnight, adding AI to their names to attract funding. Cloud giants, AWS, Azure, Oracle, began a data center arms race. Saudi Arabia announced plans to build one of the world's largest AI data centers, joining the global rush to power intelligence with silicon and electricity. Every bubble starts with a belief, a story so powerful that valuation becomes secondary to vision. In the dot-com era, it was every company needs a website.
Around the world have been the technology stocks, including the dot-com companies.
In crypto, it was money without borders. In AI, it's machines will think like humans. But when capital chases belief faster than profit, speculation replaces substance. Today, firms are valued not on earnings, but on model size, number of GPUs, or access to proprietary data. Companies justify billion-dollar valuations by promising breakthroughs in AGI, artificial general intelligence, something no one can define, let alone deliver. And at the core of this frenzy lies a quieter, more structural force: circular financing. Circular financing in AI refers to a web of interconnected business transactions, investments, and partnerships among major tech companies where money flows in a closed loop. A company invests in a partner or customer who then uses that capital to purchase goods or services from the original investor, creating the appearance of robust organic demand and explosive revenue growth, even when the ecosystem is feeding itself. The primary participants in this system include AI model developers, OpenAI and Anthropic, and chip makers like Nvidia and AMD, and then cloud giants Microsoft, Oracle, and Amazon. Consider the loops. Nvidia pledges $100 billion in investments into OpenAI. OpenAI then turns around and spends that capital on Nvidia's GPUs, to build massive data clusters, sending the money right back to Nvidia as record-breaking revenue. OpenAI signs a multi-billion-dollar deal to build data centers inside Oracle's cloud, and Oracle's market value surged by $244 billion when the deal was announced. It, in return, pours billions into Nvidia hardware to support those very models, completing a loop between three major players. It's a cycle of mutual reinforcement, a system of circular financing where every player's growth props up the others. Meanwhile, market data paints an even starker picture. According to JP Morgan, just 30 companies heavily invested in AI now make up 44% of the S&P 500's total value, creating historical index concentration. The so-called Magnificent Seven dominate performance charts, their price trajectories climbing for above long-term moving averages, while PE ratios stretch into territory unseen since the late 1990s. And by some estimates, this AI boom is 17 times larger than the dot-com bubble and 4 times bigger than the 2008 financial crisis. The AI mania isn't just fueled by innovation, it's powered by narrative. Executives speak in existential tones.
I think AGI will be the most powerful technology humanity has yet invented.
Each line moves billions in market cap.
San Francisco has been our home since day one. The city is important to us and to the tech industry in general. We're looking forward to continuing to grow here.
Media headlines glorify every advancement, from AI-generated music to humanoid robots. Even browser wars have returned. OpenAI and Perplexity recently launched their own AI-powered browsers, each promising to reinvent the internet. Yet beneath the headlines, a quieter force is spreading through the market: AI washing, the performance art of intelligence. AI washing is the deceptive practices of marketing products as AI-powered when they aren't, or when they rely on nothing more than basic algorithms. It thrives on overstated capabilities, misleading automation, and claims of machine intelligence where human labor is quietly doing the work. Some companies even brag about AI-enhanced products when the technology was only used during development, not in the final product itself. The examples are telling. Amazon's Just Walk Out system, hailed as a breakthrough in AI retail, was later revealed to rely on thousands of human reviewers. Coca-Cola advertised a drink as created by AI, even though the tech played out only a small, mostly promotional role. And dozens of startups pitch advanced AI that is in reality rebranded software. This is the hype machine at full throttle, where storytelling outpaces science and FOMO replaces due diligence. But hype has a cost. When expectations grow faster than results, reality eventually bites back, and that moment may be closer than investors think. For every Nvidia printing record profits, there are hundreds of AI firms burning cash to stay alive. OpenAI loses money on every user interaction. By some estimates, it burns 36 cents per query, and on its most advanced models, a single request can spike to nearly $1,000, turning every prompt into a costly spark. Its compute bills, primarily to Microsoft and Oracle, exceed its revenue growth. The same applies across the industry. Expensive hardware, soaring electricity costs, and limited monetization. Even tech giants are feeling the strain. Amazon announced it would cut 14,000 corporate jobs globally, citing AI-driven efficiencies. Yet insiders reveal the real reason: cost pressure and overinvestment in automation tools that haven't delivered results. Other firms are quietly rolling back AI deployments. A Swedish fintech replaced 700 support agents with chatbots, only to rehire humans after customer satisfaction collapsed. Economists call it the boomerang workforce. But beneath the labor turbulence lies a deeper macro risk. Former IMF First Deputy Managing Director and a Harvard professor, Geeta Gopinath, warns that AI could amplify the next global recession, turning a slowdown into a deeper, longer crisis. AI poses 3 systemic risks. 1. Labor markets. AI can replace workers, not just in routine jobs, but in even higher skill cognitive roles. And during economic slowdowns, companies usually automate even faster, which can lead to a jobless recovery. According to Gopinath, AI can put up to 30% of jobs in advanced economies at risk, making the labor market more unstable. Number 2, finance. Trading and risk models rely increasingly on opaque, self-learning systems that break down in unfamiliar conditions. If many models retreat from risk simultaneously, they could trigger herding, fire sales, and rapid market crashes. And number 3, supply chains. AI forecasting boosts efficiency, but when trained on bad or outdated data, it can amplify errors, making disruption sharper, faster, and far harder to control. Her concern isn't the technology itself, but the speed at which economies are rewiring around it, without safety nets, oversight, or resilience. In a recent essay for The Economist, Gopinath estimated that a severe correction in AI-driven markets could erase 35 trillion in global wealth, roughly 1/3 of the world GDP. U.S. households and foreign investors are far more exposed to equities than ever. A crash could wipe out 20 trillion in U.S. wealth and 15 trillion abroad, crushing consumption and global demand. Nobel laureate Daron Acemoglu warns that AI's true impact will be modest, automating only about 5% of all tasks and contributing to just 1% to global GDP growth this decade. Meanwhile, the physical cost of AI is exploding. Data centers demand enormous power, often equivalent to entire small cities. The environmental toll is mounting. Heat, emissions, and water use in arid zones where facilities are sprouting. If data is the new oil, energy is the new debt, and this debt is compounding fast. Bubbles rarely burst from a single event. They deflate under the weight of too much belief. But 3 catalysts could bring this one down. First, falling returns and rising costs. The AI boom now faces a mounting financial strain driven by collapsing returns and skyrocketing expenses. The cost of advancing AI are soaring, and training subsequent models is exponentially more expensive. A recent MIT study found that despite historic investment, 95% of companies using generative AI report zero ROI, exposing a widening gulf between spending and actual value. Many firms are pouring money into AI not out of strategy, but out of fear, chasing hype rather than outcomes. Second, infrastructure risk. The AWS outage this year exposed how fragile the backbone of AI really is. During the outage, a major chunk of the internet went down, and for nearly 15 hours, major platforms went dark. Snapchat, Reddit, WhatsApp, Signal, Roblox, Xbox, and even Amazon's own services. As hyperscalers race to build data centers, overcapacity looms, and if demand falters or a new technology like quantum computing makes today's infrastructure obsolete, trillions in sunk cost could vanish overnight. Underneath these structural cracks, the credit markets are sending another warning, one Wall Street has seen before. A credit default swap, or CDS, is essentially Wall Street's way of betting on survival. It works like insurance on a company or government's debt. The buyer pays a steady premium, and the seller promises to step in if the borrower collapses. And when nothing goes wrong, the seller pockets the fees, but when a credit event hits, the payout can be massive. CDSs can hedge risk or amplify it, and during the 2008 crisis, they formed a dense web of leveraged bets and opaque agreements that magnified the crash. Today, they're lighting up again. The CDS premiums themselves are rising, a sign that markets are demanding more compensation for perceived risk. According to a recent Bloomberg report, traders have been buying credit default swaps, effectively betting on the possibility of Oracle Corp defaulting on its debt. And Morgan Stanley expects this trend to continue as Oracle funnels billions into the AI race. a signal that even Wall Street hedges its faith in the boom. Third, regulatory backlash. AI is advancing faster than policy, creating a vacuum ripe for speculation and manipulation. Governments lack clear rules, and major initiatives like California's AI safety bill have stalled, leaving investors unsure of the regulatory rules of the game. Governance failures heighten danger. Enormously valuable AI systems still operate with minimal oversight, raising the risk that a major model could misfire, trigger market damage, and prompt a nationwide moratorium. Meanwhile, ethical pressure, bias, deepfakes, job losses, and rising energy costs is building political resistance that could abruptly slow AI development and investment. Investor sentiment can shift faster than code can compile. When confidence breaks, liquidity evaporates, and even trillion-dollar companies can tumble. The cracks in the system are becoming harder to ignore. But what comes next isn't as simple as an imminent crash. Like every technological revolution, AI will produce both casualties and compounding long-term gains. And it's here that veteran investors are beginning to diverge sharply from the euphoria. Michael Burry, the contrarian icon of The Big Short, has taken one of the most aggressive stances yet, building more than $1.1 billion in put options against Nvidia and Palantir before deregistering from the SEC. His concern isn't about AI's potential, but its accounting. Burry argues that many AI-driven profits are being inflated by stretching depreciation schedules and masking the true economic strain of massive capex. History, he warns, has a pattern. In every great boom, railroads, dot-coms, housings, stocks peaked even as capital spending kept rising, only to collapse shortly after. Today's AI cycle looks eerily similar. Even Bill Gates has hinted that many AI investments will end as dead ends. But this isn't a call for panic, it's a call for discipline. In a market oscillating between fear, FOMO, and trillion-dollar valuations, survival becomes a strategy. For investors now, possible AI bubble: 1. Focus on fundamentals. Ignore the noise. Prioritize companies with strong free cash flow, real earnings, durable margins, and clear use cases. Storytelling doesn't pay dividends, cash does. Number 2, differentiate between AI companies. Don't chase every small cap stock with AI in its name. Favor established leaders with real moats: chip makers, enterprise software, cloud providers, and firms powering the infrastructure, data centers, networking, and energy. Number 3, diversify boldly. Spread exposure across sectors like industrials, healthcare, financials, and geographies. Avoid letting your portfolio become a leveraged bet on one narrative. Number 4, be tactical, non-impulsive. Build positions in high-quality companies during temporary sell-offs, not at momentum-driven highs. Let volatility work for you, not against you. 5, respect the cycle. AI will drive real productivity gains, but booms always outrun fundamentals. Decide which regret you can live with: missing an upside or absorbing losses you can't recover from. The AI future is transformative, but in short form, the real edge is staying solvent while the story unfolds. The AI revolution is real, and the bubble around it, also real. Trillions are being wagered on a vision of machines that can reason, create, and replace us. But today's systems are still pattern matchers, not minds. Investors are betting on the illusion of intelligence, and illusions don't scale profitably. When innovation meets speculation, history always rhymes. The question isn't whether the AI bubble will burst, it's who will survive when it does. Because every revolution needs excess to ignite progress. The trick is knowing when the story shifts from building the future to betting on fantasy. If you found this analysis valuable, hit the like, subscribe, and comment